Hey, Bill Bergfield here, and I want to welcome you back to the Retire Smarter series. I'm glad you're here. Today's topic is one that I feel that's very important. It's probably, well, maybe the most important, and without a doubt, it's the most misunderstood. I think it's the most misunderstood subject in all of retirement planning as far as that goes. If you've ever heard of the 4% rule, you've probably been told it's the gold standard. I don't think so. You've been told it's the safe harbor. I still don't think so. The rule that guarantees you'll never run out of money in retirement? Yeah, that's what you've been told, but I don't think that's holding water anymore. You see, for decades, financial planners, even YouTube channels, and retirement books, they've all repeated this 4% rule over and over again, like it was scripture. They tell you, withdraw 4% of your portfolio per year and you're going to be just fine during retirement. Here's what I believe is the problem. The world that rule was designed for no longer exists. You see, as far as I can tell, interest rates, inflation, and now life expectancy, and even market valuations, they've all shifted. They've shifted dramatically since the rule was created way back in 1994. And yet millions of retirees are still planning their entire retirement around a 30-year-old formula as if nothing has changed. I do believe that's a serious mistake. And in this video, I'm going to show you exactly why I think that. And more importantly, I'm going to show you what to do instead. You see, by the end of this video, you will understand, one, why the 4% rule is broken. Two, what the hidden danger called sequence of returns risk is and why it can wreck a retirement, even if the math looks good on paper. Three, what withdrawal rate does Morningstar's 2023 research actually recommend? And then number four, I want to show you 4 proven strategies you can use right now to make your money last for 30 years or even longer. If this is your first time here, this channel is dedicated to practical, data-driven retirement planning ideas. And I want to repeat that. It's planning ideas. It's no fluff, no filler, just the information you can actually use in conjunction with coaching and direction from your financial expert. Here's what I'd like to ask you to do. Hit subscribe and ring the notification bell. That way you won't miss the next video in this series. So let's go ahead and dig into it right now. Before we can talk about why the 4% rule is broken, we need to understand where it came from and what it was actually designed to do. You see, because the rule itself, the rule is not bad. It's not bad thinking. It just reflects conditions of an older time. In 1994, you see a financial planner named William Bengen published a paper that changed the retirement planning world. Bengen took 50 years of historical market data going all the way back to 1926. He ran analysis after analysis to find probably what he considered the highest withdrawal rate that would not have depleted a retirement portfolio in any historical 30-year period. Now, what he found was what he called the 4% rule. That figure became known as SafeMax, the maximum safe withdrawal rate that you can use year after year and still not deplete your retirement funds. Now, I want to explain just a little bit how this maybe works in practice. In the first year of retirement, you're encouraged to withdraw exactly 4% of your total portfolio. So, if you have $1 million, you would be encouraged to withdraw $40,000 in year number 1. That's roughly $3,333 a month. Not great, but not bad either. But then each subsequent year, you adjust that dollar amount upward by the prior year's inflation rate, the consumer price index or the CPI. This ensures that your purchasing power stays constant over time, even as prices continue to rise. The rule was modeled on a 60-40 portfolio, 60% stocks and 40% bonds. That blend was considered classic. It was a classical balanced retirement allocation, stocks for growth, bonds for stability and income. At the time Bergen ran his numbers, bonds were yielding 6 to 8%. That income component was doing enormous heavy lifting to protect the portfolio during stock market downturns. Here's the critical detail that almost no one even thinks about mentioning when they talk about the 4% rule. It was built for a 30-year retirement span, a 30-year retirement horizon, not 35 years, not 40, just 30. The world in 1994, as compared to today, the world was very different. People retired later, lived shorter lives on average, and interest rates, they were structurally pretty high. All four of those foundational assumptions have changed, and that's exactly why I think retirees have a problem. I want to look at these three biggest structural breaks, if we can, here for a minute. So what exactly has changed since 1994 that makes this 4% rule what I call unreliable for today? There's three fundamental structural shifts, and I want to bring them to point. Each one alone would be enough to cause me some concern, and certainly should cause you some concern. Together, they make a compelling case that the old rule needs to be, for lack of a better word, retired, right alongside the people that are trying to use it. Here's the first problem that I see. The first problem is bond yields. When Bengen ran his original study, bonds were yielding 6 to 8%. That meant the bond side of a 60-40 portfolio was generally protecting and growing the portfolio, paying substantial interest income that could maybe fund withdrawals during stock market downturns. But today, even after the rate rises of 2022 and 2023, real yields, meaningful yields, yields after inflation, they remain substantially lower than they were in the 1994 study period. The bond cushion that made the 4% rule work has been dramatically reduced. This is nothing compared to the second problem, though. The second problem is inflation. The 4% rule was calibrated against historical inflation averaging around 3% a year. In 2022, the CPI spiked to 9.1%, the highest rate in 40 years. Even if inflation moderates back towards the 3 or even to the 4% level, a retiree withdrawing a fixed 4% and adjusting upward for inflation, they're watching their portfolio disappear far faster than the historical model anticipated. A decade of 5% inflation? Oh, wow. That would do some devastating damage to retirees' purchasing power. And then let's talk about the third problem. The third problem is lifespan, longevity. The 4% rule was designed for a 30-year retirement period. But today, a healthy 65-year-old couple has a 50% probability that at least one of them is going to live to age 90, maybe even beyond that. That's a 25-year retirement for one person, or potentially a 35-year retirement if they retire at 55 or 60. You see, the longer the retirement, the lower the safe withdrawal rate must be. A 35-year horizon requires some real meaningful and much more conservative planning than that 30-year horizon did. Let's put all three of these together. Lower bond income, higher inflation, and longer retirements. And then Morningstar's 2023 State of Retirement Income Research concluded that the actual safe withdrawal rate today is not 4%, it's 3.3%. That's a 17.5% reduction from 4%. On $1 million portfolio, that difference is $7,000 less per year in withdrawals. That's real money, folks. And understand this, it compounds over decades into massive, it's a massive difference in retirement security. Now, I want to introduce you to what I believe is the single most dangerous and the least understood concept in retirement finance. It's called sequence of returns risk, and explains why two retirees with identical portfolios and identical withdrawal rates can end up with completely different retirement outcomes. Here's a scenario. Imagine two retirees. Let's call them Robert and Maria. Both retire on the same day with $1 million in their portfolio. Both withdraw $40,000 per year, exactly 4%. Both experience the same average annual return over the 30 years. Let's say 7% per year. The only difference is the order in which those returns arrive. Poor Robert. Robert's unlucky. In his first year of retirement, the market dropped 30%. His portfolio fell from $700,000 before he takes his $40,000 withdrawal, leaving him with $660,000. Now he needs that $660,000 to recover and continue to fund his $40,000 annual withdrawals. No matter how you look at it, folks, the math is brutal. When the market recovers in 3, 4, maybe 5 years, those gains are applied to a much smaller base. He sold shares at the bottom to fund his living expenses, and those shares are gone. They'll never recover. By year 17, maybe 20, Robert's portfolio is completely exhausted. He runs totally out of money, with potentially 10, maybe 15 years, maybe more of retirement still ahead. But Maria's lucky, you see. In her first year of retirement, the market gained 25%. Her portfolio rose from 1,000 or from 1 million to 1,250,000. She takes her 40,000 out, leaving $1,210,000 in the account. From that high base, even when bad years come, her portfolio has the size and momentum to absorb withdrawals and continue compounding. Her portfolio survives comfortably well past that 30-year period. Same portfolios, same withdrawal rates, same long-run average return. Completely different outcomes, solely because of when the bad years hit. This is why the 4% rule alone is not really sufficient in my mind. It was based on historical average returns, not the catastrophic risk of a bad sequence in the first 5 years of retirement. That early window is the most vulnerable period. In the next slides, what I'll talk about, I'll look at strategies. I'll show you strategies specifically designed to protect you during those critical early years. I want to start by putting some real numbers on the table, because this is where the rubber really meets the road. I want you to look. Let's look at 3 withdrawal scenarios on a $1 million portfolio. And then let's understand exactly what each one means for your monthly budget and for your long-term security. At 4%, that classic rate, you withdraw $40,000 in year number 1. For decades, this was the number. The problem, as we just went over, is that it was calculated for market and interest rate conditions that, well, they no longer exist. Morningstar's 2023 research indicates a meaningful probability of portfolio failure at this rate over a 30-plus year horizon in today's lower return, higher inflation environment, it's not a guarantee of failure, but the margin of safety is definitely uncomfortable. At 3.5%, which I'd call the middle ground, you withdraw $35,000 per year. That's roughly $2,900 per month. This is a reasonable rate for retirees who have flexibility in their spending, people who can cut back in a bad year without feeling a crunch, who have some guaranteed income from maybe Social Security or a pension, or who are comfortable making adjustments in their expenses. It's meaningful. It's safer than 4%, but it still carries some risk over very long retirements. At 3%, the Morningstar's 2023 State of Retirement Income Report identifies as the most resilient for a 30-plus year retirement horizon. Say you withdraw $30,000 per year or $2,500 a month. This is the most conservative option, but it comes with the highest probability of success. For retirees who plan to live into their 80s or in their 90s or maybe even into their hundreds, who have significant healthcare expenses on the horizon or who have limited guaranteed income from other sources, this rate provides what I think is the most reasonable and reliable long-term security. Here's the key. The gap between 4% and 3% it's only $10,000 a year. That's roughly $830 a month. But the difference in portfolio longevity and peace of mind, that's enormous. And as we'll see in the next few slides, there are strategies that can bridge that income gap without requiring you to save another $1 million. The 4 strategies we're about to show you, they're designed to give you the security, I believe the security of the lower withdrawal rate while supplementing your income from other sources. So let's take a look. We spent the first part of this video understanding the problem. Now let's get out of that. Now let's talk some solutions. This is much better. Strategy number 1 is called the bucket strategy. You've probably heard of this one. And it's one of the most effective tools ever developed for managing with retirement withdrawals. This is important. Managing retirement spending. The core idea behind the bucket strategy is simple. Instead of managing your retirement savings as one giant undifferentiated pool of money, you deliberately divide it into 3 separate buckets, each with a different purpose and a different time frame, a different time horizon. This structure does something that I think is, very psychologically and financially powerful. Here's what happens. It means you never have to sell growth investments at a loss just to pay your grocery bill. Bucket 1. Bucket 1 is your cash bucket. Think of it as your short-term living expense account. This bucket holds 1 to 2 years. I'm going to say that again. It holds 1 to 2 years of living expenses in an extremely liquid environment. High yield savings account, maybe, money market fund, or a short-term CD. When you need money this month or next month, you take it from this bucket. The critical benefit, you're never forced to sell stocks or bonds during a downtime. You're never forced to sell them during a market downturn to cover immediate expenses. This eliminates, folks, it eliminates the worst effects of returns and risk and sequence of returns versus risk. So bucket number 2, this is your income bucket. It's your medium-term, let's call it your medium-term engine. This holds 3 up to 10 years worth of expenses in a moderate risk account. Something income generating, but still an investment. Short and mid-term bond funds, maybe. Dividend paying stocks, yeah, okay. A bond ladder, perhaps, or REITs for income. The purpose of this bucket is twofold. 1, generate some steady income. and periodically replenish bucket number 1 as it gets drawn down. When bucket 1 is running low, you top it back up with money from bucket number 2, giving your growth investments more time to compound. This is important. This time to compound is important in longevity. Bucket number 3, let's call that your growth bucket. It's your long-term engine. It's your fighter against inflation. This bucket holds everything beyond 10 years worth of expenses. I suggest make sure it's diversified. Some growth-oriented investments, yes. Equity index funds, okay. International stocks, yeah. Growth ETFs, okay. And real assets, yes. This money does not get touched for 10 years or more. It has the full runway it needs to recover from any market downturns. And it can significantly outpace inflation. This is where your wealth compounds over the long arc of your retirement time. The genius of this bucket system is that it converts an abstract concern. What is that? Will I run out of money? That's the abstract concern most retirees have. It converts that abstract return into a concrete, manageable process. You know exactly where your next 2 years of income is going to be coming from, regardless of what the stock market does today, tomorrow, next week, or even next month. Strategy number 2 is what I call the dynamic withdrawal method. Specifically, the guardrails approach. Kind of a strange name, huh? This was developed and popularized by financial planner Jonathan Guyton. It's now supported by a growing body of research, including Morningstar's own retirement income work. This dynamic withdrawal method, this fundamental concept, has insight behind dynamic withdrawals. And here's that insight. The 4% rule fails because it's completely rigid. It says withdraw the same inflation-adjusted amount every single year, no matter what the market's doing. But real life is not rigid, folks. I know that. You know that. Real life's just not rigid. Markets have good years and they have bad years. People have good years and they have bad years. A smart retiree should depend a little more in the good years and save a little more in the bad ones. Let's put it another way. A smart retiree could spend a little more in the good years and spend a little less in the bad ones. This is just common sense, folks. And it turns out to be just really powerful when modeled mathematically. The guardrails method works by setting 2 trigger points, guardrails, around your portfolio value. Here's how it works in practice. The upper guardrail. If your portfolio grows more than 20% above its starting value, and what that means is that markets have been generous. What you can do now is give yourself a 10% raise. If you were withdrawing $3,000 per month, you can now withdraw $3,300. You're rewarding yourself appropriately for a strong market. The normal zone. This is the medium, the mid guardrail. If your portfolio is performing within expected parameters, not dramatically up, not dramatically down, here's my suggestion. Simply maintain your planned withdrawal rate. No changes, no anxiety, no fear, no decision making is required. The normal zone. But then there's the lower guardrail. If your portfolio drops more than 20% below its starting value, you temporarily need to cut your spending by 10%. If you're withdrawing $3,000 per month, you need to just temporarily drop to $2,700. That's only $300 per month in reduction. You can look at some of your insignificant expenses and take care of that. But it's definitely not going to create a crisis. You might eat out maybe 1 or 2 times less than you normally would, but you might hold off on a vacation. You might trim some discretionary expenses, but you'll survive. Here's why this is such a simple adjustment and why it's so powerful. According to Morningstar's research, a retiree who applies the guardrails method, they can extend their portfolio's longevity by an average of 5 to 7 years. compared to a fixed withdrawal approach. 5 to 7 years of additional runway. That means if you hit 90, you may even bump to 100. That's extraordinary return on a modest temporary sacrifice. The other benefit that this guardrail concept offers is kind of unappreciated, but it's extremely psychological. The guardrails give you a clear preset rule for every possible market scenario. You never have to wonder. You don't have to wonder in a down market whether you should panic, sell, or drastically change your lifestyle. You know the rule. Down 20%, cut spending 10. Then wait. That clarity reduces anxiety enormously. Strategy number 3 directly addresses one of the most consequential financial decisions you'll make in retirement, in my opinion. When to claim Social Security. And the research is remarkably clear on this one. For most retirees, especially the higher earning spouse and a married couple, delaying Social Security is one of the highest return, low risk moves possible. Let me kind of walk you through the 3 claiming ages, what they actually mean in dollar terms. If you claim Social Security at age 62, the earliest possible age, you're going to receive approximately 70, maybe up to 75% of your full retirement benefit. That reduction is not temporary, not just for a couple of years, folks. It's permanent. It's that for your entire retirement time. It follows you for every month the rest of your life. On a benefit that would have been $2,000 per month at full retirement age, claiming at 62 means you're going to receive only about $1,400. Maybe at most $1,500 per month instead of the $2,000. And this reduced amount is the base that the future cost of living adjustments are applied to. Crazy. So that the gap actually compounds over time. If you wait until 67, the full retirement age for most people born after 1960, you're going to receive 100% of your earned benefit. This is the baseline. The Social Security Administration calculates from your 35 highest earning years. If you wait until 70, the maximum delay, you could receive 124 up to maybe 132% of your full benefit. Every year you delay past full retirement age, your benefit grows by approximately 8%. That is a guaranteed, government-backed 8% increase. Show me an investment that matches that with zero risk. Between the age of 62 and the age of 70, the cumulative difference is approximately 70%, 76%. Let me correct that. It's approximately 76% more monthly income over the lifespan. Now, the obvious question, how are you going to pay your bills between retirement, the day you retire, say at age 62, and age 70, if you're not claiming Social Security? This is where the bridge strategy comes in. You draw modestly from your investment portfolio, ideally from bucket 2 or bucket 3 in your bucket strategy to cover the gap. Yes, you are drawing down the portfolio somewhat, but you're purchasing a permanent inflation-adjusted income increase that will pay dividends for potentially 20, maybe 30 years. The math almost always favors the delay, particularly for the higher earner in a married couple, where the survivor will inherit the larger benefit. Social Security, folks, is one of the only guaranteed inflation-adjusted lifelong income streams available to a retiree. I encourage you to use it strategically. Strategy number 4, and the final strategy. It's one that makes many people uncomfortable. It's because of a strange word, and I'm going to say it out loud. It's because of annuities. Now, I understand that instinctive caution. The annuity industry has a troubled history of complex, fee-laden products that enriched salespeople far more than it did the retiree. But there's a specific, simple type of annuity that does deserve some consideration in a modern retirement plan. And understanding the difference could be genuinely life-changing. The product I'm talking about here is called a single premium immediate annuity, or SPIA. Here's what it does. You hand an insurance company a lump sum of money, and in exchange, they're going to guarantee you a fixed monthly income payment for the rest of your life, period. No matter what the stock market does, no matter how long you live, the payments never stop, and you can't outlive them. At current rates, let me give you some examples here. At current rates, a 65-year-old investing $200,000 in an SPIA can receive approximately $1,200 to $1,400 per month for the rest of their life, a payout rate of roughly 6 to 7%. That's a significantly higher than the safe withdrawal rate from an investment portfolio, precisely because the insurance company is pooling mortality risk across thousands and thousands and thousands of policyholders. Now, here's how an SPIA fits into a comprehensive retirement plan, how it kind of shoves in there. What's called the floor and upside model. The annuity creates a guaranteed income floor that covers your fixed essential expenses: housing, food, healthcare, and utilities. Once those non-negotiable bills are covered by guaranteed income, Social Security plus the annuity, your investment portfolio is completely free, completely liberated from the pressure of any mandatory withdrawals. It can stay invested for long-term growth, ride out market volatility without forcing to sell anything, and compound over time without the constant drain of essential expense withdrawals. The recommended approach that I found for most retirees is to annuitize approximately 20 to 30% of your portfolio, enough to meaningfully cover core expenses, but not so much that you lose flexibility or liquidity. You want your portfolio, folks, to retain growth. You want it to retain growth potential for discretionary spending, maybe healthcare surprises, or even legacy goals. And here's my critical caution here. I'm specifically talking about simple, low-cost, single premium, immediate annuities. I am not talking about variable annuities, indexed annuities, or annuities with riders, bonuses, and complex surrender schedules. I'm not talking about those. Those products are often laden with fees of 2 to 3% per year and benefit the salesperson far more than the recipient. Stick to the simple, transparent SPIA. Compare quotes from multiple insurers and here's my suggestion, work with a fee-only fiduciary advisor who has no commission incentive to sell you a more complex product. That, folks, is important. We've covered a lot of ground in this video. From the structural problems with the 4% rule to what I see as a sequence of returns risk to 4 powerful alternative strategies. Now let's put it all together let's put it together into practical action framework you can actually use. Step number 1, calculate your real number. This sounds obvious, but most retirees have never actually done this. Well, they might have tried it, but they've never done it correctly. Sit down and add up every essential monthly expense: your mortgage or your rent, your property taxes, your property insurance, all other insurance, your health care premiums, out-of-pocket costs, your food, your utilities, your cost of other types of transportation, any debt payments you may have. These are your non-negotiable expenses, the ones that must be paid whether the market goes up or whether it goes down. Now, multiply your annual total that you get out of all of these things put together, multiply that total by 25. That's the portfolio size you need to cover just your essential expenses at a 4% withdrawal rate. Then add a buffer for healthcare inflation and unexpected costs. That's step 1. Step 2, map your guaranteed income. List every source of guaranteed money that you have coming in or that you will have coming in. Social Security benefits, pension income, annuity payments. These add up. Now, subtract them from your essential expenses. The remaining gap is your actual portfolio withdrawal needed, the amount your investments need to cover each year. For many retirees, this gap is smaller than they even thought, way smaller than they feared, and especially smaller if they delay Social Security and maximize the benefit. So that's step 2. Step 3, I want you to choose your strategy mix based on your gap analysis and your personality, specifically your comfort with, well, let's call it with market volatility. Combine the strategies we've discussed. Use the bucket strategy for structure and peace of mind, but apply the dynamic guardrails so that you have a clear path for every market scenario. And if your guaranteed income gap is large, consider an SPIA annuity to create a stronger income floor. That's step 3. Step 4, review all this annually and adjust it as you need to. Once a year, ideally at the same time each year, perhaps tied to tax season. Reassess your portfolio value. Check out your actual spending, and evaluate and pay attention to current market conditions. Apply the guardrail rules if a threshold has been crossed. Rebalance your buckets and make sure your plan still reflects your current situation. One final note. The single best investment you can make as a retiree is working with a fee-only fiduciary financial advisor, someone who is legally required to put your interests first and who charges a transparent, flat fee rather than commissions. They can build a personalized version of this framework tailored specifically to your specific tax situation, specifically to your estate goals, specifically to your healthcare needs, and most specifically to your risk tolerance. Cost of good advice is trivial. It's trivial when you compare it to the cost of a retirement plan that fails. Before we close, I want to give you a clear and what I call a crisp summary of the 5 important things I want you to take away from this video. Takeaway number 1, the 4% rule, no longer reliable. The structural conditions that made it work, high bond yields, moderate inflation, and a 30-year retirement span, all that's shifted. That's no longer true. The current safe withdrawal rate, according to Morningstar, 3 to 3.5%. If you're planning around 4%, you are taking on more risk than you probably should. Takeaway number 2. A sequence of returns risk is the hidden killer of retirement plans. It doesn't matter what your average return is over 30 years. If you experience a severe bear market in the first 5 years of your retirement, the order of returns matters enormously. And this risk requires active management, not passive acceptance. Look at it, pay attention, make adjustments. Takeaway number 3, a 3-bucket strategy is one of the most powerful tools that's available for anyone that wants to manage risk. By separating your money into cash, income, and growth buckets, you're going to ensure yourself that you never have to sell your long-term investments just to cover short-term needs and short-term expenses. The simple structural change. This change can make an enormous difference in how long your portfolio is going to last you, and an enormous difference in your own peace of mind. That's takeaway number 3. Takeaway number 4, dynamic withdrawals. Specifically when you're using the guardrails method, can extend your portfolio's life by 5 to 7 years without requiring you to change your lifestyle drastically. A 10% spending reduction in a down market, folks, that's petty. And it's just a temporary sacrifice that delivers outsized long-term benefits, truly. Takeaway number 5, the ultimate goal is to build a guaranteed income floor from Social Security and potentially a simple SPIA annuity. And then let your investment portfolio grow without the burden of mandatory essential withdrawals. When your portfolio is free from that pressure, it can compound more aggressively and support a better overall retirement long term. These 5 concepts taken together represent a retirement withdrawal framework that I think is significantly more robust than the classic 4% rule. I want to encourage you to put them to work in your plan, but be absolutely sure, be absolutely certain that you consult your own personal financial advisor because they know your situation. You know your situation. I don't know your situation. I'm simply offering ideas here. They can actually sit down with you and through these ideas create a workable plan, no doubt. And so that's a wrap really for today. Let me leave you with this thought though. I want to go back to this 4% rule. The 4% rule was never a guarantee. It was just a rule of thumb, folks. And it was really just a starting point. Retirees that are going to thrive over the next 30 years plus are not the ones who blindly follow that old formula. They're the ones that are understanding today's risks. They understand building flexibility and creating some diversified income strategies. And they review and adjust all of those things regularly. Now you know the things that the huge majority, I'm going to say the vast majority of retirees, and honestly, many financial advisors don't fully understand. You know about sequence of returns risks, the bucket strategy, the guardrails method. You know about Social Security delay and intelligent use of simple annuity income floors. That knowledge is genuinely valuable. I want to encourage you. Understand it and put it to work. If you want a printable step-by-step action guide from this video, you can download the free retirement withdrawal strategy checklist. The link is in the description below. And really, what I'd rather you do is just comment below and just tell me that you'd like to get a copy of the retirement withdrawal strategy checklist. If you found this video helpful, I want to encourage you, hit the like button. It genuinely helps more people find this content. And that's the whole point of this channel. Subscribe, ring the bell so you don't miss the next video in the Retire Smarter series. Speaking of which, the next video answers one of the most searched retirement questions in America. Are Social Security benefits taxable? Ooh, there's a good one. The answer surprises most people. And the strategies for minimizing your tax burdens in the future, it can save you thousands of dollars a year. Hey, hope you have a great day. We'll talk to you again soon.